Have you ever wondered why the prices of essential goods are so high now? This is primarily because of inflation, but it could go down at some point. Depending on what's going on in the world, the prices of goods can change. When the COVID-19 pandemic hit in 2020, the whole global market went down. Today, the conflict between Russia and Ukraine caused oil prices to rise worldwide. This event has caused global markets to plunge again suddenly. Is this a good thing or a bad thing? This is Capital Finance. In this video, we will learn about the stock market's cycle and how to make the most of it to advance our wealth. The stock market has had many ups and downs throughout the years. However, the long-term trend is upward. It doesn't matter where you put your money in the market. In the long term, you'll have more money than you put in. If you invested during one of the recessions in history, your investment must have grown since the market has already recovered. In recent years, there has been unprecedented growth in the industry, particularly after 2011. Consider the S&P 500. The rate of expansion has been continuous, rather than allowing the market to correct itself and recover on its own. The Federal Reserve has recognized that it can create trillions of dollars, put it into the economy, and it will recover much faster, which has worked rather well for the previous two crises. February and March of 2020 stand out as a time when the market went into freefall. The stock market had never gone down so quickly and so severely. The fact that this crash recovered almost immediately sets it apart from all others. That's why many analysts believe the market will drop again, since this phenomenon is not usual. It's impossible for the market to increase that much without the help of cheap money. But why hasn't there been a crash yet exactly? What's keeping it going? And when will it finally end? Before we begin, make sure to like this video and comment your thoughts below. Let's get started. Number 1. Correction. Are you familiar with the term correction? It is nothing more than a minor fall in the value of a market index or the price of a specific asset. Most experts think that a correction occurs when a stock's value drops by 10% to 20% from its previous high point. Fortunately, if you are wise enough, you'll most likely take advantage of this situation when it occurs, since that is the best moment to buy. Every few months, the market has a correction, and each time it appears as if the market would collapse once more. But this has never happened, and it doesn't appear that it will in the foreseeable future either. Our economy has seen an unprecedented boom for the past year or two. This is the point in time when the economy starts to expand again. Number 2. Economy grows again, and the Federal Reserve assists through cheap money. Then it bursts. At some point, economic growth slows down because it has reached its limit. Interest rates have been raised to their maximum level by the Federal Reserve to keep inflation under control. But this limits the amount of money available for economic growth, so the economy barely increases and manages to keep up with inflation. When the bubble bursts, the economy collapses because of a chain reaction. There were 3 instances of this in 1999, 2008, and 2020. That's when the Federal Reserve comes in with cheap money to assist the economy recover faster by cutting interest rates and buying corporate and government bonds. The economy returns typically to pre-crisis levels within the first year or two. Finally, everything explodes until it gets to the peak again, where things slow down until they crash once again. Number 3. What causes this cycle to continue? Even though no one can predict the future, there are generally several signs that hint at the economy's direction. Because our economy is heavily reliant on consumer spending, the Federal Reserve cut interest rates to almost 0% as a short-term fix. People's spending drives the economy in a circular motion. When they stop, everything comes to a halt and there's nothing you can do about it. So, The government took a more straightforward way by artificially keeping the wheel moving while we are coming out of the pandemic, which apparently was a very good move. But it never said anything definite about when it would hike the rates again. To save the economy, they declared they would do all they could to keep interest rates low for as long as it takes for the economy to recover. Many economists predict that rates won't be hiked until next year, which sounds logical. Anything can happen between now and then, but that's the most likely outcome. The Fed is adamant about raising interest rates as nobody enjoys the high cost of living, while Fed officials continue declaring they had inflation under control. Growth in recent years did not come without a cost. Inflation was a price to be paid for the changes. Real estate prices have skyrocketed worldwide, particularly in the United States and Canada. Prices of homes don't suddenly rise by 20 or 30%, a tenfold increase over their typical rate, to put it simply. The past year and a half have been a great experiment. When it comes to printing money, we've never done so much in a short time before. Furthermore, this is a worldwide issue, not simply a problem in the United States. Since there are no previous examples to compare, it isn't easy to guess how things will turn out. Investors are also concerned about the Chinese real estate market's possible impact on the rest of the globe. China's economy is not isolated. Every country globally, notably the United States, is economically linked to China. As a result, the United States and the rest of the globe will be adversely affected if China experiences a recession. Chinese ghost cities are undoubtedly familiar to you from images on the internet. There aren't many investment instruments accessible in China, which is an issue. Although they have a stock market and large global firms like Alibaba, Tencent, and so on, they are extensively controlled by the state, making their long-term opportunities uncertain. When their CEO gets into a fight with the Communist Party, there will be a crackdown on their business. One of China's most well-known businessmen is Jack Ma. Billions of dollars of his riches were lost while in hiding after criticizing the administration. Since real estate appears to be the most secure investment for most Chinese people, they choose to put their savings into it. It is possible to transform real estate prices into a source of passive income since they increase in value and are not affected by inflation. Although that tactic has backfired because they have built much more houses than the country needs, resulting in a massive surplus of housing in the country. 0.25% of homes is vacant, and whole structures have been demolished because no one has occupied them in years. A similar phenomenon occurred in the United States a few years ago, where people in China purchased their third home as frequently as they purchased their first home. The 2008 market collapse was caused by cheap loan rates and permissive rules that encourage individuals to buy many homes they couldn't afford. Naturally, this is a simplification, but it captures the essence of what transpired. The same might happen in China, which would negatively influence the global economy. However, this is only speculation because no one knows when the bubble will burst or how devastating its effect is on the economy. Based on current evidence, it does not appear that we are about to experience a crash, and one has not occurred in the previous year or two. If you can't predict the crash, dollar cost averaging is your best bet. Thank you so much for being all ears during this video. I hope you learned a lot. Make sure to like this video and subscribe to Capital Finance. Until next time.